Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I am your host, Dax White. This is a show. This is a different take on the investment show. I'm not going to give investment advice. I'm not a licensed professional. That's not what we're trying to do here. Instead, I'm going to try to pass along some of the things I've learned about the brokerage industry, having litigated hundreds of cases against brokerage firms on behalf of investors, sort of shine a light on some of the tricks that they do so that the next time you're meeting with your advisor, maybe you'll even the playing field a little bit, ask some great questions, and get some better responses from your broker. Make sure that you're having a productive investor financial advisor relationship. So each week we're going to try to tackle different topics. When we first started out, I felt like we were sandwiching a lot of information, but maybe not giving you the quality that we're looking for. So we're instead going to try to just tackle maybe one, two topics a week. And this week, what we're going to be talking about are hedge funds. It used to be hedge funds was primarily or almost exclusively a product that was purchased by institutional investors, whether that's banks or pensions. But it was never really a concern for a show like this where we're talking about Main Street investors, mom and pop, retired, worked their whole lives, saved $600,000, and now they're dealing with a financial advisor looking for some income for retirement. Hedge funds wasn't something that usually came up. But over the last few years, we've seen this product expand, and certainly now it's sold retail by a lot of the brokerage firms, and I have concerns about it, just in terms of not the product, but in terms of how the financial advisor is maybe selling that product. What are the representations he's making, she's making, to make an investor feel like, oh, this is perfect for me. They're typically very high commission products for the financial advisor. So you anytime you have that, you run the risk that they're bad financial advisors, and brokerage industry is like anything else, not unlike lawyers. There's good ones and bad ones. Unfortunately, I deal with the bad ones. So, and the bad ones usually are maximizing their commissions at the expense of clients. And so if you have a high commission product, there's always the risk that the bad ones make improper recommendations and are trying to sell it to the wrong people. So that's sort of what we're going to touch on. We've got a great guest for you today, someone I'm really excited to bring onto the show, particularly for a local show. I feel like this is a big get for us. His name is Peter Phillips. He is works for hedge funds. Sorry, I had his background right here. Here we go. He's a senior alternative investment professional, having worked for Blackstone and BlackRock, two of the biggest companies in the world, certainly in finance. And he's currently co-head of investment solutions for a hedge fund. He's based in New York. So, Peter, thank you for joining us.
No problem.
I know, Peter, from talking to you that you've spent a little bit of the last year putting together a product that will be sold retail. Is that correct?
That is correct, yes.
Okay. Tell me a little bit about the product and,
Sure.
Just in general, how are we getting from institutional investors and now we're selling it retail to, what I like to call mom and pop investors?
Yeah, I think, Dax, obviously, for the most part of my career, I've dealt with institutional investors, and you had indicated initially that institutions have predominantly been the key source of assets for hedge fund investments over the past 25 or 30 years. And if you look at the average institutional investor, they're very well diversified across equities, fixed income, commodities, hedge funds, private equity, where the average retail investor does not have that level of diversification. And a lot of that historically has been through a lack of choice or a lack of options. And the hedge fund industry and some of the firms that I've worked with have recognized that need for diversification really is what it comes down to. And if you look at over the past 15 years, the average 60-40 equities fixed income portfolio has been about almost perfectly correlated to equities in terms of returns. So the retail investor is in need of diversification, and what form that takes, I think, has really blossomed over the last few years. And there's been a proliferation of liquid alternative products or hedge fund products into that space.
So
I can tell you
from the sales side, I imagine that the objective then is to target investors who have a relatively substantial net worth, who need that extra layer of diversification that they don't currently have. They want to get into hedge funds, but we're talking maybe 5% of their portfolio, right?
Yeah, 5-10% at most. I think if you look at the performance of hedge funds over the past 25 years, what they've been able to, at least good ones, and you alluded to that initially, the good ones can generate an attractive return with far less volatility in return as you might see in equities. But most importantly, if you look at the average hedge fund returns in periods of market stress, take 2008 for an example, the average hedge fund was down 19%. Now, they do lose money. I think that's the misconception. A lot of people investing in hedge funds thinking that they always make money. They will lose money, but they can insulate a portfolio where equities were down, depending on the index, 40, 45%. In 2008, the average hedge fund was down 19. Some hedge funds made money in 2008. So I think that's what's driving this demand.
I guess what my concern would be, and I'll segue it into my follow-up question, but my concern would be that you have an investor who simply looks at the return and says, wow, this guy made 37% last year and the S&P was at 20 or whatever the numbers might be. And they're thinking, give me more hedge fund. And do we have financial advisors who are saying, no, pump the brakes here. We're really only permitted to put 5 to 10% of your portfolio here. And I don't know if you're going to see those safeguards. Maybe it's in the sales agreements that you're getting with retail, and you could speak on that. And that would be one question. Second question would be, what are the minimums typically for an investor to get in?
Sure. So maybe I'll talk about the sales agreements initially, and I was not as involved in that aspect of the negotiation. And I think, to your point, I think what you're getting at is there is the risk that a financial advisor who does not have his client's best interest in mind can overweight an allocation to hedge fund. And I would look to the brokerage firms to have safeguards in place to prevent that type of risk. But obviously, you know better than I that some brokerage firms are better than others at doing that. The minimums typically will depend on the product. So most will be anywhere from, I'd say, $25,000 to $50,000 minimum investment, which most hedge funds are used to $2 million or $5 million minimums on the institutional side. So it is quite a difference.
So what are they doing that? Tell me why the hedge funds would be interested in a $25,000 investment, because now they've got that many more clients they've got to service and deal with. Are the brokerage firms sort of aggregating and saying, here's our $5 million from all of our clients, or are the hedge funds directly having to now have this relationship where client services becomes a huge issue?
Not with each of the underlying clients. So the most of the, as you indicated, it's aggregated and it's managed at the brokerage level. I think the reason hedge funds are getting into this space is really given the level of scale. So they're willing to take smaller minimums because there's such a vast amount of capital out there that has historically not been invested in hedge funds, whereas most institutions have been invested for quite some time. And I think those markets, as they've become saturated, hedge funds have looked to retail as a way to diversify their businesses, even at lower minimums.
Talk to me about fund quality, because I know from talking to you in your background that you've, I think it was with Blackstone, where you worked for a fund of funds where you basically vetted a variety of funds and then sold a mutual fund, wrong word, but basically that's what it was, to institutional investors saying, hey, we've vetted them for you. These are the good ones. Talk to me about fund quality, because I'm sure there are a lot of hedge funds out there that want to raise money, but they're not necessarily very good at what they do.
Yeah, no, I think you've hit the nail on the head. The biggest risk in hedge fund investing, and having done this for the past 13 years, is that the dispersion of returns between the very best and the very worst hedge funds is significantly wide. So if you think of an active equity manager that's benchmarked to the S&P, for example, you got a pretty good idea based on how broader equity markets perform, how that manager will perform. And the differentiation between the best and worst is not that significant. It's even less significant in fixed income, where it's very difficult to outperform benchmarks. In hedge funds, it's completely different. So, just to give you an example, in the equity hedge fund world, over the past 15 years or so, you could see a variability in returns of almost 30% between the best and worst performing manager. So if you're picking bad managers in hedge fund space, almost assuredly you'll be disappointed in returns. It's very important to pick good managers and have access to good managers. And so that's why the fund-to-funds approach, even in the mutual fund side, might be very attractive to the average retail investor, because you're investing through an experienced, established manager who's going to select those individual hedge fund managers for you. And they have robust processes in place to be able to select the best managers. Again, you touched on fees. It's going to be even more expensive through a fund of funds, but I think you get a higher quality of underlying manager that way, with risk management, operation due diligence, all of those things that they're doing on your behalf.
We talked at the beginning about how this is sort of a new, proliferation where, hedge funds, obviously the incentive for them is they've got this new capital resource. Hey, let's go direct to clients. Tell me exactly how much this has proliferated at this point, because, obviously, you've worked for some of the biggest finance companies in the world. The fact that BlackRock might put together this product doesn't necessarily ring huge bells for me, but I have dealt with a number of small hedge funds where it's really just 2 or 3 guys, and we see it a lot in Florida in particular, because they love to set up shop here where they can put all their money in their house, and they've got the homestead exclusion or exemption, and you find out they've been ripping people off, and you can't sue them, and there's no money and whatever. So how far away are we from those guys being able to go to brokerage firms and saying, hey, will you sell my product? I'll pay you, the top end of the commission, and suddenly we've got mom and pop investors in that type of hedge fund.
I think it's a risk. I will say one of the benefits of proliferation is that some of the bigger and better and more well-established firms like BlackRock and Blackstone are now getting into this space. If you rewind 4 or 5 years ago, when not many hedge funds and virtually no fund of funds were launching mutual fund products, I think the selection was far less of a far lower quality. So I actually think it's a good thing for the industry that the likes of the J.P. Morgans, Blackstones, BlackRock are launching products in this space, because you can count on a high quality of investment service as a result of that, and you might squeeze out some of these smaller players who are not as high quality. I definitely think it's a risk. One thing to keep in mind is if you're a hedge fund that's very aggressively raising money in retail, you might want to ask the question, why is that? Are they having trouble raising money elsewhere? And they see retail as a path of least resistance, and that might speak.
They're always the last one.
Right.
Yeah. I'd much rather start with a pension who has $100 million to invest as opposed to a mom and pop who has $25,000. So you only have to land one. I completely agree with you. Before I let you go, Pete, I was going to touch on this after the break, but I bet you our listeners would rather hear it from you. Tell me just in a minute or two, what makes a hedge fund versus a mutual fund? I mean, we're talking complicated strategies, derivatives trading. What makes it a hedge fund?
So this is a great question, and a question I've gotten many times over the last 13 years. I think the word hedge fund is somewhat of a misnomer. Hedge fund managers are really not doing anything that a traditional investment manager is doing. The key difference is they're doing it with fewer constraints. And that's why in the past you tend to find hedge funds only in limited partnerships, because there are fewer constraints and regulations on limited partnerships. So the ability to short, the ability to use leverage, things that a traditional investment manager would have a harder time utilizing. Hedge funds have I think of it as they have more tools in their tool chest to enact their strategy, and the biggest difference would be they're typically not benchmarking themselves to a broad market index. They're targeting an absolute return and using as many tools as they can to achieve that return. And that's where you tend to find the low correlation. The diversification benefit is that, if the market's up or down 25%, depending on the strategy of the hedge fund, that may or may not have a dramatic impact on their returns.
Gotcha. And tell me just briefly, how are hedge funds? What's the compensation structure? I know, we touched on a little bit last week in terms of what the brokerage firm might make for raising the money, but what's the hedge fund taking?
So typically in the structures that we have worked on, in the mutual fund space, the hedge funds are earning a flat fee only, so they do not earn incentive fees. A typical structure for an institution will be management fee plus incentive fee, and on average that can be as high as 2% management fee and 20% performance. In the mutual fund space, they're typically going to be a flat fee, and we've seen them in the range of as low as 80 to 0.8% to 1% flat. And the managers that we were utilizing in our multi-manager strategy were on average about 90 basis points at 0.9%.
So if it's 2% flat, and that's basically covering administration costs and client services, et cetera, I assume. And then 20% performance. Concern I would have as somebody who works to protect investors is that would make a huge incentive for a hedge fund to have a huge return. And maybe that's not the objective of all their clients, but if their compensation is based off of 20% of their return for the year, aren't they trying to maximize return absolutely in every situation?
I think it depends on the fund. One thing to look out for and for investors to look out for is, at the very least, to make sure that managers have high watermark structures in place such that if they have a dramatic loss, they have to recoup all of that loss before they can earn that 20% incentive fee again. And those type of structures will and have kind of led to that less of that incentive to kind of shoot the lights out to earn a higher performance fee. Because by the same token, if you lose a significant amount of money, you have to recoup that loss before you'll earn that incentive fee. And many hedge funds in 2008 that lost a significant amount of capital, they found it easier to just shut down than to try to recoup those losses. So they can have a material impact on business. Gotcha.
Well, Pete, I really appreciate you joining us. Thank you for giving us the perspective of somebody who's actually in the business and has been involved in putting together these products for retail. I really appreciate you joining us.
No problem. Thanks for having me.
Have a good one.
Bye-bye.
Your eyes are usually the first thing that people notice about your appearance. They are probably the most important aspect of facial attractiveness. Even with a good night's sleep, loose skin over your eyes can make you look tired, sad, or older than you really are. In severe cases, vision can become partially blocked. Come for a consultation with Dr. David O'Brien. Look and see better with the help of New Vision Eye Center. Visit newvisioneyecenter.com or call 772-257-8700. New Vision Eye Center offers bladeless laser cataract surgery. Drs. Paul Minotti and Stephen Tate want you to be fully informed about all of the options available to you when it's time for your cataract surgery. We offer a gentle, bladeless, computer-guided procedure. This technology delivers unsurpassed accuracy and precision. Visit cataractsurgeryverobeach.com or call 257-8700. When it's time for cataract surgery, make the move to the Cataract Institute at New Vision Eye Center in Vero Beach.
Hey, Treasure Coast, need to clear clutter from your house? Want some spare room for your spring remodeling projects? Uncle Bob's has the space you need. Uncle Bob's Self-Storage just opened 2 new stores, one on 20th Street in Vero Beach and another on South Federal Highway in Port St. Lucie. Come celebrate with a special deal. Right now, Uncle Bob's will give you up to 1 month free on your second month of storage. Stop into one of these new locations or visit online at UncleBob's.com. That's UncleBob's.com.
And we are back with Wall Street versus Main Street and your host, Dax White.
Welcome back, everybody. Hopefully you enjoyed that interview with Peter Phillips, who's co-head of institutional sales for a large hedge fund in New York and has previously worked for BlackRock and Blackstone. So certainly I think he's got a great perspective if hedge funds was something that interests you. And hopefully we touched on some of the concerns I would have as we start getting down in this proliferation towards smaller investors, because hedge funds, again, I feel like I say this every week, but every product has a time and place. And, the institutional investors even that are investing in hedge funds, huge pensions, it's usually a very small percentage of their investment. And so those are the concerns I have when we start talking about mom and pop. Let's make sure, that it's somebody who frankly has the net worth that is indicative of somebody that should be in hedge funds. And even then, let's make sure that it's a small percentage of your portfolio to just give them that extra layer of diversification. So hopefully we've got that across. The next topic I wanted to talk about, because again, each week the objective is to sort of pass along information that I think would be helpful to investors, based on my experience as a securities attorney who sues brokerage firms. And one that I thought was pretty obvious that we haven't talked about yet is, how do I sue my brokerage firm? Not everyone out there realizes that they even have the ability to do it. A lot of the people that we talk to think, oh, I lost money and I took my lumps on that. And that may not be the case. In some situations, that absolutely is the case. Because just because you lost money doesn't mean you have an actionable claim against your brokerage firm. That's something you need to talk to a securities attorney about to really evaluate it. I mean, the reality is in 2008, regardless of where your financial advisor put your money, you were going to lose money. There were no safe asset classes. That doesn't mean you have a claim. If you had a beautifully blended portfolio that was well diversified between equities and bonds and cash and all these other elements, you still probably lost money. But if you tracked the market, your broker didn't take advantage of you, your broker wasn't negligent, you probably don't have a claim. But for people who were taken advantage of, again, a lot of those people don't realize, I have recourse. And the answer is yes, you do. And that recourse is a process that's called FINRA arbitration. Whether or not you realized it when you established your brokerage relationship, somewhere buried in the fine print of your agreement with them was language that said something, and I'm paraphrasing, but something to the effect of, if you have a dispute with us, you agree to waive your right to sue us in court and instead to sue us through FINRA arbitration, or formerly called the NASD arbitration. And that's been in virtually every brokerage agreement for decades now. So if you have a relationship with a brokerage firm, you can't sue them in court. You're going to be stuck suing them through the FINRA arbitration process. FINRA is the self-regulatory body for the industry. They've got a regulatory component where they actually go out and audit brokerage firms to make sure they're complying with securities rules. But they also have this dispute resolution forum where you file the claim through FINRA, and then you're going to get a list of potential arbitrators, and eventually 3 are going to be appointed to hear your case, and they operate as basically the judge and jury for your dispute, where they make evidentiary rulings, they make rulings on what evidence can come in, and they also make fact-finding. They ultimately will tell you whether or not you're entitled to any kind of recovery. It's a very, I call it the Wild West. It's very different than court litigation. They've got their own code of arbitration, their own rules. So it is important that you are working with an attorney that does that type of work. And there are only about 100 to maybe 200 throughout the country that's all they do. There's lots of lawyers that'll take a $500,000 case on contingency fee. That doesn't mean that they understand the FINRA arbitration business. That doesn't mean they understand the brokerage industry. And it's a very small community. There's only maybe 100 to 200 lawyers that's all they do. They're in the trenches every day fighting with brokerage firms. And it's important to know brokerage firms definitely defend these claims. They're going to hire some huge firm in New York or Miami or wherever, and they're going to pay them a lot of money, and they're going to make you do a lot of work if you're on your own and don't have a lawyer. And they treat even though it is arbitration, not court, they treat it just like it's court in terms of the effort they put into in defending these claims. So that's something to consider. The reality is you actually don't have to have a lawyer for a FINRA arbitration case, but that's something to consider about whether or not you should get one.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.